In this video, I'll be showing you guys how to create a simple portfolio for yourself, how to analyze the historical portfolio's returns, and how to forecast the returns for the sample portfolio that you have determined and you are willing to invest your money into. So let's say, for example, you have $12,000 to invest and you want to allocate 100% of those funds. There are different ways you could allocate that fund money. For example, for in this portfolio that I'll be showing you, it's all going to be in equity. However, you divide your portfolio by commodities, fixed income, derivatives, and all that. However, for this portfolio, since we are talking about equity, I'll be also showcasing you guys how the historical returns of this portfolio that I have chosen are, and what is the forecasted portfolio is expected to be in future. So let's first focus on the companies or the ETFs I have chosen. The ETFs I have chosen, as you can see, four are Invesco, QQQ, which tracks Nasdaq 100, Vanguard, VTI, which tracks overall stock market index, Invesco Solar, which is more towards energy and renewable energy companies, and Arc Innovation by Cathay Wood, which focuses also on innovation and technology companies. Allocation you can determine by yourself. However, for this portfolio, I have chosen 50% in Invesco, 30% in Vanguard, and then another 10% in Invesco and ARC. And I'll show you why I have chosen those allocation. So as you can see, why I chose those four ETFs, I'll show you guys exactly how I found those and why I chose those. So if you go on Portfolio Visualizer's website, and you could utilize your fund screener from this tool section, and then figure out different ETFs, mutual funds or closed-end funds by equity type. Like for example, I chose US equity. You could choose international equity. It is all dependent on your allocation. If you want to invest in bond, if you want to invest in alternative investment commodities, and then this section will show you different ETFs, and I chose growth. And when you update the table, you can see you could see large growth. Since I selected that fund category, you could see returns by different years, volatility, which Sharpe ratio, Shortino ratio, what our asset under management is, and inception date. And when you do that, you will find portfolios with different returns. Let's analyze the returns of those four ETFs over historical period of 2015 to 2020. You could do it for any years if you have an ETF that dates back to 1985. Since ARC was formed in November 2014, I chose this 5-year period. 12,000 is the initial amount, as I mentioned in this Excel file, and then $6,000 is the annual contribution which you do in your Roth IRA. We will keep everything else the same, which is rebalancing annually, contribution annually for $6,000, inflation adjusted returns, and the allocation by different tickers. So let's say you started with $12,000 and you invested $6,000 per year. In 5 years, you could see your ending balance to be $125,000. If you had invested in 2015 January, your final balance would have in December 2020 would have been $125,000. Your return would have been 47% or 48%. These are different money weighted and time weighted returns. Your risk, which is the most important factor, 18%. As you can see, the returns is higher and so is the risk, and that's the trade-off that investors have to make. With this portfolio, if you are young and if you want to do it for your Roth, you could take it since it has a higher return. However, you will also be facing higher risk. You can see this portfolio had the best year of 69%, the worst year of 3%, and the maximum drawdown, which is the maximum amount of loss in a particular year or particular month you suffer, is 16.31%. Then Sharpe ratio and correlation, you could see the portfolio growth over time period. You could do inflation adjusted and how you could see your final return would have been $112,000 instead of $125,000 on a nominal basis. You could analyze 3 year, 1 year return, and also the volatility of 3 year and 5 year period. So for 3 year you could see higher volatility, and the main reason being your exposure to tech itself here, which is heavy tech, and less of other equity sectors. uh, you could see the fees ratio, yield, the PE ratio of different ETFs itself, the return contribution towards the amount of money you invested, and the risk contribution. For example, TAN and ARK had the least risk, and the reason being those are the smaller allocation of your portfolio. However, return is the most provided by this because it has a higher weight. However, now if you look at overall portfolio return, annualized is 24%. You could look at the different matrices to analyze for yourself. You could look at the return in different years, the inflation in different years, to analyze how much return it would have you would have realized in particular year, and from different ETFs how much return you would have realized from particular year. Then monthly returns, then drawdowns. This is the most important thing you want to look at when you're analyzing a portfolio or looking at it for yourself. And this is a simple one. You could do a deep inside research onto it. However, I'll not talk about that right now. I'll just focus on this simple using the portfolio visualizers website. uh, Different assets, its correlation to the stock market. You can see Vanguard has the one because it is this portfolio tracks the overall market, monthly correlation, annualized return of different portfolios. And the main reason I chose ARK and 10 is because I feel over long time investors, as more younger investors enter the market, they will shift more focus towards technology and renewable energy companies, which are the higher growth companies, and which is why you could see returns starting to increase for those two companies over last 2 years or last 3 years, and going into future I do expect them to increase. And then rolling returns over annualized period. So now let's forecast how the portfolio is expected to do using Monte Carlo simulations. So initial amount is $12,000. You're going to be contributing 6,000, and this is a sample Roth IRA that I'm doing. However, you could do it for your different portfolio, different contribution annually, different contribution by different years. I chose statistical returns. You could choose forecasted, for which you will have to provide them with the mean adjusted returns. You could utilize historical returns, and then the time frame within that, and then parameterized returns. And then you could for the time series model, you could do normal model returns or gauge, or you could just expect to leave them same, and then allocation. And then once you run the simulation, you will see the simulation summary generated down below. You can see Monte Carlo does not give you a specific number, however it gives you a different percentile, and here you will see that the returns from 10th percentile to 90th percentile differ by a lot. For example, time weighted return, nominal return, and real return, which is inflation adjusted, basically are 16% and 14% for 10th percentile, and for 90th percentile 26% and 24%. It doesn't mean that you are expected to fall within this line. You could fall higher or below depending on how the market performs, or how this portfolio itself performs over the next 30-year period that we have chosen right here. As you can see, the nominal balance 4.7 million for 10th percentile, 42.5 million for 90th percentile. The max drawdown 36% or 28%. What is the max drawdown excluding the 6,000 cash flow is 39, and then 21 here. And then we could look at the simulated assets and their expected return, and then annualized volatility over the next 30-year periods. ARK definitely has the highest expected return and higher volatility. This Vanguard, which tracks the stock market itself, has lower return and lowest amount of risk. We could look at the expected returns by different years, for example 1 year, 3 year, 5 year returns. What is the probability of earning a particular return or a higher? For example, you could expect to earn 12.5% or higher. Your chances of earning that much return is almost 99% over next 30 years according to Monte Carlo simulation. Same thing with loss. Your chances of losing 40% is zero over time. However, your chances of losing, let's say, 7%, 10% is 16%. So over time you could see your loss, especially the amount of loss you expected to suffer, is less. You could look at the histogram to see the ending balance of the portfolio and the maximum drawdown. Please like, share and subscribe this video. If you have any question, please drop down them into comment section below. And I thank you for your time, and I hope you understand how to create a portfolio, how to analyze it from scratch, and then choose the allocation.